CAD number for FY13 has been revised. October-December current account deficit is yawning at $31.9 billion, about $32 billion. Current account gap fell to 3.6% of GDP in the Jan-March quarter, and the current account or the CAD gap is at about 4.8% of GDP versus 5.2. Now, the fact that
versus 4.2, Nikunj, that's on a year-on-year basis, a comparable, so it's gone higher. 4.8% is where it is. And at a time when you already have the rupee weakening so much, this data is not going to go down so well.
Yes, and then rupee in fact has weakened only after this. So it's really the problem area is this quarter. Problem area is not the quarter gone by. For the quarter gone by, in fact, rupee had appreciated. So this data surely will not go down very well with market watchers. Just when we were hoping that, look, macros for Indian economy have bottomed out. The CAD data for the quarter gone by is not impressive, and the fall in rupee will only challenge macro data going forward. So I guess it's too early to assume that Indian macros have bottomed out. There is a yawning gap of about $32 billion. What may help the CAD data this time around only in the fag end of this quarter is the fact that gold and crude prices have come down. But 4.8 versus 5.2 is something which surely will not go down very well with bond market watchers and rupee market watchers.
Indeed. In fact, we're going to just await some more details in terms of what really has gone wrong and what has actually led to this data. 4.8 versus a GDP figure of 4.2 on a year-on-year basis. So those are the data points that we're picking up. And I'm just going to recap the data coming in from the Reserve Bank of India for the benefit of our viewers who've just tuned in. The FY13 current account gap stands at 4.8% of the GDP versus a comparable of 4.2. The current account gap fell to 3.6% of the GDP in the quarter Jan to March. Also, the merchandise exports, they've gone up by about 5.9% in Jan-March quarter. The trade gap now stands at $45.6 billion in the Jan to March quarter versus $51.6 billion. That's on a year-on-year basis. The forex reserve addition, that's been to the tune of about $2.7 billion, and the Jan to March CAD, that stands at $18.1 billion. Also, the Jan to March quarter financial account surplus has come in at $17.6 billion.
Samiran, have things improved? Things surely have improved between Q3 and Q4. Do you think markets are likely to get excited, or markets are likely to focus on the current affair because CAD data, what has come out today, has got no meaning because rupee only has fallen in this quarter?
I think it will have a very marginal impact on the market sentiment at this point of time because, as you said, it is old data, and this is a large part of this data was already known to the market, particularly on the trade side. So clearly this is not too much out of line with that. In any case, there's a seasonality in Q4 because of which the current account deficit looks much better in that quarter. We think that in this quarter, that's the June ending quarter, we will see that the trade deficit will probably worsen further and current account deficit will also worsen. So that's why I don't think this number will be cheered a lot by the currency markets.
This is actually a bit lower than what we at Axis Bank had anticipated, around about 20 billion odd. I believe it's coming around 18 billion. One couple of points. One, of course, this is the past because this was the old January to March quarter. So we had a relative handle on what the numbers were likely to be. Pleasant surprise, I haven't seen the breakups. So obviously the pressures have not been that accentuated as we had initially thought. And that was the indications from the behavior of the rupee. So one of the things that I can immediately sense that some part of the current account, which were the investment outcomes or inflows via remittances, must have been higher than what we had initially imagined. Going into the current quarter, given the weakness that we have seen in the rupee, and from whatever levels that we have seen of in terms of the fundamental drivers of the current account, in terms of trade, in terms of service, merchandise and service exports, I believe the numbers, except for May, because May up to the April to May numbers were distorted by the enormous imports of gold, and those imports have now reduced, stabilized. The numbers that I've seen in terms of fuel consumption, petroleum products consumption, have also stabilized. So from the merchandise and the services side, I believe the current account deficit in the current quarter, which is the critical quarter now for the Indian currency, I believe those numbers will be a little better than what we are currently seeing. Coming to the third point, the second point that you had mentioned in the rupee, in terms of the rupee. Given what we now understand in terms of the balance of payments possibilities in this current quarter, and particularly in June, where the slide in the rupee started, our sense is that this is more to do with foreign flows, expectations on the rupee, rather than a sharp deterioration in India's external fundamentals. Certainly there would be an element. Certainly there will be an element in terms of capital flows. But the underlying risks in terms of the current account, which is what drives capital flows, etc., I think are relatively better than what we are now projecting.
Maithili, your first take on the Q4 CAD data.
Well, the numbers are largely in line with expectations. And to the extent that this is historical data and most of it has already been factored in, it will not significantly affect sentiment, because I think markets are essentially forward-looking, and both in April and May, our trade deficit figures were pretty high. So I would expect that the first quarter of the current fiscal, we will see the current account deficit again rise. But to the extent that the past data for the previous last quarter of the last fiscal has come well in line with expectations, I think is good news. It will not significantly affect the rupee, because unfortunately, as the previous speaker said, many of the changes that the government has made, many of the improvements, many of the policy announcements that the government has made, they've all come a little too late when the global environment has changed for the worse. But certainly this will prevent, the bad sentiment, the pessimistic view from taking, further actions, as it were.